Hey everybody, it's Ron from Ron's Basement. Thank you for joining me today. Are you serious? Are you serious? Have you looked at the valuation of your typical precious metals mining stock? It is ridiculous how low these companies have gone, and from what I see, what a great value opportunity they are. It has been a really rough, I don't know, couple of months, it feels like. I don't know, it was a blur. 6 weeks in the precious metals mining sector. I got into the sector kind of earlier in the year, built up some big positions, and then actually got out of most of them during that run-up we had, I guess, in May, June-ish. I don't know, maybe it was April, May. And then started getting back in around June. And let's just say I got in a little too early, and it has been painful. I mean, I thought the valuations were crazy back then. So I think they're more crazy right now. That does not mean that they can't get more crazier in the future. But let me just touch on a few things. Just a few. If you just look at the financial condition of these mining companies, they are in awesome shape. Most of them have very little or no debt whatsoever. If you look at the balance sheet and you take their total assets and you get rid of any fluff, any goodwill, if you look at their tangible assets, their real assets, okay, and then you net the debt out of that if there is any debt, and then you compare that, that's called net tangible assets, you compare that to the market cap, the total market cap of the company. A lot of times it's about equal, or in some cases, I think like with Equinox Gold right now, their net tangible assets are actually higher than the market cap of the company. Okay? So I know that there was a crash in the gold mining stocks after the last all-time high back in whenever it was, 2011, whatever. Well, all those companies were loaded up on debt, had made a bunch of crazy. It's a different picture now. We are not dealing with the same companies. We are not dealing with companies in the same financial condition. These companies learned their lesson. The industry learned their lesson. And now you've got companies that's like the healthiest of any. Go look at the balance sheet of Apple Computer or General Motors or AT&T. A lot of those companies, when you take their real tangible assets and then take the debt out of it, it's actually, they're upside down. They've got more debt than they do real net tangible assets. But their market caps are like billions and billions of dollars. It makes no sense, okay? To further that argument, point number two, these gold mining companies, a lot of them, or most of them, and as a whole, are making awesome cash flow. They're making money. They're generating cash, okay? So you got these companies you can buy for like a discount to the book value of their assets, and they're generating cash. It's like me saying, hey, my house is worth 400 grand. I'll sell it to you for 300, and then you can rent it out for 2,500 a month. It's crazy. Okay, the last three things I want to touch on are more positives, potential positives for the gold mining industry. The gold price, hey, it can go down, but it could go up. And if it goes up, every time it goes up by, let's say, $100, that's generally an additional $100 of cash flow for the company that's producing that ounce of gold. Okay? Number two, on top of the price of gold going up, a lot of these companies have a growth profile. They're growing. They're going to be producing more ounces. Equinox Gold, huge growth profile. Fortuna Silver, and there's a whole lot more. Kinross. So if you got companies that potentially are going to have a higher price for the product they sell, gold, so they're going to be making more profit per ounce, and they're going to produce more ounces, that creates like an opportunity for like exponential-ish type growth in cash flow, okay? Thirdly, and this kind of goes back to what I was talking about earlier, what I started with, overall the multiples, the actual kind of value assigned to the overall gold mining sector is ridiculously low. for these companies that are in great financial shape, making positive cash flow, I think the average overall is like 8, like the average price to earnings ratio in the precious metals mining sector is like 8 or 10, whereas in the rest of the market, it's like 23 or 24. So think about that. These companies in great financial shape could be selling their product and making more profit on each unit they sell, each ounce they sell. They can be making more of these ounces, producing more, and then if a higher multiple is applied to that higher profit number, I mean, the sky could be the limit. So yeah, it sucks owning a bunch of precious metal mining stocks. It's part of the game. Could it go lower? Yeah. You know, I think that to a certain degree, there's a certain value floor we're approaching in the precious metals mining sector. Could it go higher? Yeah, it could go a lot higher. It could, okay? And at some point, you know, I heard this saying once, and I'm going to slaughter it, but I'll try it anyway. You know, math shows no forgiveness on the altar of truth, meaning eventually things revert to where they should be and maybe even overshoot. I mean, could you imagine if we had $2,300 gold, your gold, let's just use Equinox, your gold company was producing twice as much gold at $2,300, because Equinox could in the next couple of years produce twice as much gold. So you're making like twice as much profit per ounce, you're producing twice as much of the product, you're getting twice as much profit per ounce on, and instead of being valued at a average 8 or 10 multiple, it's valued at a 30 multiple. I mean, that's how unbelievable returns are achieved. What's the downside? Sure, there's some downside. You know, I mean, definitely. Ask anybody who bought Equinox Gold last summer. There's downside, 50%. Is there further downside potential from here? Maybe. You know, maybe. I don't know, though. If you think about, you know, would you take a bet that, you know, you got about equal chances that your value of your stock's going to either go down by 50%, but just as much of a chance that it's going to go up by 5%, or I'm sorry, 5 times, 500%? That's a good bet. And there's 4 types of bets. Good bets, bad bets, bets that you win, and bets that you lose. A good bet is one like I just talked about. That's called asymmetric. Okay? That's a good bet. And unfortunately, you don't always win good bets, but if you make enough good bets over time, you come out way ahead. If you're still watching, thank you for watching. I hope you have a great day, and we'll talk to you soon.